Divergence in the Fed's interest rate cuts. The economic game behind the 125 basis point policy storm, a stunning divide at the Fed. 125 basis point rate cutting storm versus hardline stance of no action. Which side are global capital markets betting on? In September 2025, U.S. Financial markets are experiencing an unprecedented bout of policy expectation volatility. The radical statements from Federal Reserve Governor Milan and the strong opposition from three officials, including St. Louis Fed President Musalem, have formed the sharpest public divergence at the Fed in nearly a decade. This debate over whether to cut interest rates by 125 basis points within the year not it only affects the nerves of Wall Street, but also serves as a key indicator for observing the direction of the U.S. economy. According to the latest report from the Congressional Budget Office, CBO, the U.S. real GDP growth rate in 2025 will be revised down from 1.9% to 1.4%, while the inflation rate will be revised up from 2.2% to 3.1%. And the unemployment rate is expected to rise to 4.5%. Against the complex backdrop of slowing economic growth and sticky inflation, the Fed's policy choices have become unprecedented difficult. The rate-cutting debate, the radical proposition of 125 basis points, and its theoretical foundation. Federal Reserve Governor Milan's proposition of cutting interest rates by 125 basis points within the year means a 50 basis point cut at each of the remaining 3 monetary policy meetings, plus an additional 25 basis point cut, a scale far exceeding market expectations. To understand the radical nature of this proposition, we need to examine it in the context of history. During the worst phase of the 2008 financial crisis, the Fed's largest single interest rate cut was 75 basis points. When hit by the COVID-19 pandemic in 2020, the Fed cut rates by 50 basis points urgently before lowering them to near zero levels. Currently, although the U.S. economy is slowing down, it has not entered a recession. So such a large-scale rate-cutting plan undoubtedly breaks away from the conventional policy path. The core theoretical basis for Milan's proposition lies in his judgment on the neutral interest rate. The neutral interest rate refers to the interest rate level that neither stimulates nor inhibits economic growth. Milan estimates it at 2.5%, significantly lower than the current federal funds rate range of 4.25% minus 4.50%. This judgment is based on an expanded version of the Taylor rule, which suggests that when inflation expectations are stable and economic growth is below its potential level, the real interest rate should be lower than the neutral interest rate to stimulate the economy. According to the latest data, although the U.S. core PCE inflation rate has dropped to 3.1%, the University of Michigan survey shows that consumers' long-term inflation expectations have risen to 3.9%, creating a dual constraint on policy making. From the perspective of economic fundamentals, Milan's proposition reflects deep concerns about downside risks to growth. In August, U.S. employers added only 22,000 new jobs, far below market expectations, indicating a significant cooling of the labor market. At the same time, the Consumer Confidence Index fell for 2 consecutive months to 55.4, the lowest level since May, with evaluations of personal financial conditions dropping by approximately 8%. These data support the logic of preemptive rate cuts, using early easing to prevent the economy from slipping into a recession. Historical experience shows that the Fed's preemptive rate cuts in 1995 and 1998 successfully extended the economic expansion cycle, which may serve as an important reference for Milan's camp. However, this proposition faces practical constraints from a mathematical perspective. Based on the current benchmark interest rate of 4.375%, a 125 basis point cut would lower the rate to 3.1 to 5%, still 60.5 basis points away from the 2.5% neutral interest rate advocated by Milan. This means that even if the radical rate cut is implemented, monetary policy will still remain in a slightly tight range. This half-step to the target strategy not only reflects the urgency to stimulate the economy, but also reserves policy space to respond to future risks, reflecting the complex policy trade-offs within the Fed, similar to the current situation. Economic data at that time showed the hawks counterattack, the argument for policy restraint amidst sticky inflation. The opposing camp, represented by St. Louis Fed President Musalem and Atlanta Fed President Bostic, adheres to the tough stance that there is no reason to cut rates further this year, with its core argument rooted in deep concerns about the persistence of inflation. The logical framework of this camp can be summarized as threefold vigilance. Inflation remains far from the target. The labor market retains resilience, and the lagged effects of policies have not yet fully manifested. From the perspective of inflation data, although the current inflation rate of 3.1% has dropped significantly from its peak, it is still more than 50% higher than the 2% target. More notably, the University of Michigan survey shows that consumers 1 year ahead inflation expectations remain at a high level of 4.8%, and long-term expectations have risen to 3.9%. Such sticky expectations may make it difficult to completely break the inflation spiral. The opposing camp cites the Phillips curve theory, pointing out that the current unemployment rate of 4.5% is close to the natural rate of unemployment, and excessive easing may reignite the wage price spiral, undoing the efforts made to combat inflation over the past 2 years. The resilience of the labor market constitutes another important basis for opposing rate cuts. Although job growth in August was lower than expected, the labor force participation rate remains stable at 60.8%, and average hourly earnings still increased by 4.2% year-on-year, indicating that the labor market has not experienced substantial deterioration. Bostic emphasized in a recent speech, "We need to see clear evidence of sustained cooling in the labor market, not just fluctuations in a single month's data." This view reflects the Fed's insistence on policy patience within the institution, especially after the lesson of misjudging inflation as transitory in 2021. Avoiding policy reversals has become a key consideration. The time lag effect of policy transmission is the third key argument of the opposing camp. It usually takes 6 to 12 months for monetary policy to affect the real economy after its formulation, and the effects of the Fed's cumulative 525 basis point rate hikes since 2022 have not yet been fully released. Models from the St. Louis Fed show that the current financial conditions index is at its tightest level since 2008, and credit standards continue to tighten. Such lagged effects may naturally curb inflation in the coming quarters, and rate cuts at this time may lead to excessive policy action. Musalem specifically pointed out, taking action before the data is clear carries greater risks than acting a little later. The stance of this camp also implicitly involves safeguarding the credibility of the Fed's policies. Historically, the Fed's premature easing in the 1970s led to repeated inflation, ultimately forcing more severe tightening measures. The opposing camp has clearly learned lessons from the policy mistakes during the Burns era, prioritizing inflation control over short-term growth. This thinking echoes the tough stance of the Volcker era of trading recession for inflation stability, reflecting the enduring divergence in monetary policy philosophy within the Fed. Lessons from history, the evolution of the Fed's decision-making logic behind the divergence. The current public divergence at the Fed is not a historical accident, but an inevitable cognitive difference among monetary policymakers when facing a complex economic environment. Looking back at the Fed's century-long history, similar policy debates have repeatedly occurred at every critical turning point, and these historical cases provide important references for understanding the current divergences. The rate cut decision in September 2007 is of great comparative significance. At that time, the Fed launched an easing cycle with a 50 basis point rate cut, breaking the convention of starting with a 25 basis point cut. And this decision also faced intense controversy. Similar to the current situation, economic data at that time showed contradictory characteristics. The labor market had not yet deteriorated significantly, but liquidity tensions had emerged in financial markets. History often repeats itself, and the current Fed also faces a divergence between financial market signals and real economic data, a divergence that often becomes a breeding ground for policy disagreements. The rate cut divergence in September 2024 provides a more recent reference. At that time, Fed Governor Bowman cast a dissenting vote against a 50 basis point rate cut, becoming the first Fed governor to vote against an FOMC interest rate decision since 2005. The commonality between this incident and the current divergence lies in that both reflect the perspective differences between governors and regional Fed presidents. Governors pay more attention to systemic risks and overall stability, while regional presidents focus more on the actual economic conditions and inflation pressures in their respective regions. From the perspective of the decision-making mechanism, the Fed's divergences show obvious cyclical characteristics. Before 1995, it was not uncommon for governors to cast dissenting votes, but among the more than 90 dissents since then, the vast majority have come from regional Fed presidents rather than governors. This change stems from the Fed's efforts to strengthen policy credibility, as the chair usually seeks consensus to avoid public divergences, undermining the institution's authority. The current situation, where 3 regional presidents collectively oppose the propositions of governors, has broken this long-standing decision-making convention, indicating that the complexity of the economic environment has exceeded the explanatory capacity of the conventional policy framework. A comparison of the outcomes of divergences in different periods reveals that, when inflation risks are dominant, the hawkish view usually prevails in the end. When growth risks become the main contradiction, the dovish proposition typically gains more support. In the early 1980s, in the face of double-digit inflation, Volcker resolutely raised interest rates to combat inflation and persisted with tightening. Despite recession criticisms, during the 2008 financial crisis, Bernanke's team responded to the liquidity crisis with radical easing. The particularity of the current situation lies in the simultaneous existence of inflation and growth risks. With similar intensity, this two-peak risk makes policy choices particularly difficult. Market game, capital euphoria, and panic behind expectation gaps. The Fed's policy divergence is directly reflected in the volatility of expectations in financial markets, creating a unique expectation gap trading environment. Data from the CME Fed Watch tool shows that the market's probability of a 25 basis point rate cut in September has dropped from 63% a week ago to 45%, while the expected probability of a cumulative 75 basis point rate cut within the year remains as high as 71.6%. This gap between market expectations and the Fed officials' dot plot constitutes the core driver of current market volatility. The stock market exhibits typical policy-sensitive characteristics. The S&P 500 index surged after Milan's statements, but pulled back when hawks such as Musalem spoke out, with the volatility index VIX rising above 20 at one point. There is a clear divergence in sector performance. Financial stocks are more sensitive to hawkish remarks because a high interest rate environment is conducive to expanding net interest margins, while growth stocks, especially in the technology sector, are more receptive to dovish signals because lower interest rates reduce discount rates and boost valuations. This divergence is particularly evident in tech giants such as Nvidia, whose stock price fluctuations are highly correlated with rate-cutting expectations. The reaction of the bond market is more complex. The 10-year U.S. Treasury yield fluctuated in a zigzag pattern under the influence of divergent news, rising to a 2-week high intraday before pulling back. The shape of the yield curve is also changing. Short-term yields are more sensitive to policy expectations, while long-term yields reflect judgments on economic fundamentals to a greater extent. This divergence has deepened the steepening of the yield curve. From a historical perspective, when there are obvious divergences within the Fed, the predictive ability of the yield curve temporarily weakens as the market struggles to price in the uncertain policy path. In the foreign exchange market, the US dollar index has shown a range-bound oscillation pattern amid policy uncertainties. Milan's radical rate-cutting proposition caused the US dollar to come under temporary pressure, while the hawks' counterattack pushed the US dollar to rebound. This two-way fluctuation reflects the market's re-evaluation of the relative strength of the Fed's policies compared to those of other major central banks. For emerging markets, such uncertainty increases the volatility of capital flows. The statement by South Korean President Lee Jae-myung that U.S. investment requirements may trigger a South Korean economic crisis is a concrete manifestation of this global capital reallocation pressure. Data from the derivatives market reveals deeper market sentiment. The implied volatility of interest rate options shows that investors are hedging against the risk of black swan events, guarding against both unexpected easing brought by large-scale rate cuts and the possibility of the Fed resuming rate hikes due to a rebound in inflation. This two-way hedging behavior has pushed up option premiums, reflecting the market's pricing of current policy uncertainty. The divergent forecasts between Goldman Sachs and Morgan Stanley further reinforce this uncertainty. The former expects 3 rate cuts throughout the year, while the latter predicts consecutive rate cuts in 3 meetings. Global transmission. The spillover effects of U.S. monetary policy. The Fed's policy divergence not only affects U.S. domestic markets, but also exerts far-reaching impacts on the global economy through capital flows, trade conditions, and exchange rate channels. Against the backdrop of globalization, this transmission mechanism, where when the Fed sneezes, the world catches a cold, it has become more complex and immediate, with emerging markets particularly facing a policy dilemma. The risk of sudden stops in capital flows has risen significantly. When the direction of Fed policy is unclear, international capital tends to flow into U.S. dollar-safe assets, putting emerging markets under capital outflows pressure. Export-dependent economies such as South Korea are particularly sensitive to this. The predicament, similar to the 1997 financial crisis warned by President Lee Jae-myung, essentially reflects concerns about the tightening of U.S. dollar financing conditions. Historical experience shows that during periods of rising uncertainty about Fed policy, the scale of capital outflows from emerging markets usually increases by 20%-30%, and exchange rate volatility rises by more than 50%. Changes in trading conditions constitute another transmission channel. The uncertainty of the U.S. dollar exchange rate disturbs global trade pricing, especially causing fluctuations in the market for dollar-denominated commodities. Crude oil prices have fallen for 4 consecutive sessions to a more than 1-week low, with increased intraday volatility, reflecting both concerns about global demand and the impact of U.S. dollar exchange rate swings. For resource-exporting countries, such price fluctuations increase the uncertainty of fiscal budgets. For importing countries, they face the dual pressures of imported inflation and slowing growth. The monetary policy space of developing countries has been severely compressed. When the Fed maintains high interest rates, or there is a possibility of rate hikes, if emerging market central banks follow suit and raise rates, it will inhibit economic growth. If they keep interest rates unchanged, they will face pressure from capital outflows and exchange rate depreciation. This phenomenon of erosion of monetary policy autonomy is particularly evident in vulnerable economies such as Argentina. The statement by U.S. Treasury Secretary Yellen that all stability options are being considered to support Argentina reflects the systemic impact of Fed policy on global financial stability. Global debt risks are accumulating as policy uncertainty rises. The scale of dollar-denominated debt in emerging markets has reached a historical high, and the ambiguity of the Fed's policy path increases the uncertainty of debt repayment costs. Data from the Institute of International Finance (IIF) shows that the number of countries with an external debt to GDP ratio exceeding 35% in emerging markets has reached 32. These countries face a higher risk of debt crises during the Fed's policy shift. The severe fluctuations in Argentina's foreign exchange and debt markets are an early release of this risk. VIF future projections, policy paths, and market impacts under 3 scenarios, based on current economic data and internal divergences at the Fed. We can construct 3 possible policy scenarios and analyze the potential impacts of each scenario on the economy and markets. These scenarios are not mutually exclusive, but reflect the possible policy choices of the Fed in balancing the goals of growth, inflation, and financial stability. Scenario 1, dovish dominance, implementing a 75 to 100 basis point rating cut. Under this scenario, the Fed may cut rates by 50 basis points in September and 25 basis points each in November and December, resulting in a cumulative 100 basis point rate cut for the year. Trigger conditions may include a further deterioration in employment data, monthly new jobs below 100,000, or a sustained decline in core inflation to below 3%. In terms of market impact, the S&P 500 index may rise by 5% to 8%. The 10-year U.S. Treasury yield may fall below 3.5%. The U.S. dollar index may weaken by 5% to 7%, and capital inflows into emerging markets may increase. For the real economy, this policy intensity may keep the 2026 GDP growth rate above 1.5% and control the unemployment rate within 5%. But the time for inflation to fall back to the 2% target may be delayed until 2027. Scenario 2, middle ground, only a 50 basis point rate cut. This scenario reflects the Fed's compromise strategy, which may involve a 25 basis point rate cut each in September and December, with a cumulative 50 basis point rate cut for the year. The policy logic is small-step fine-tuning, responding to growth concerns while maintaining pressure on inflation. The trigger condition is the continued divergence of economic data, with slowing growth but persistent inflation stickiness. The market reaction may be volatile. The S&P 500 index may fluctuate around its current level. The U.S. Treasury yield curve may flatten, and the U.S. dollar index may remain relatively strong. The real economy will experience a moderate slowdown, with the 2026 GDP growth rate at approximately 1.2%, the unemployment rate rising to around 4.8%, and inflation fluctuating in the range of 2.5% minus 3%, showing the characteristics of stagflation with high inflation. Scenario 3, hawkish dominance, maintaining interest rates unchanged. Under this scenario, the Fed will not cut rates for the rest of the year, and will wait for more evidence of inflation decline. Trigger conditions include persistently high core services inflation, continued rises in consumers' inflation expectations, or signs of overheating in financial markets. The market may face correction pressure. The S&P 500 index may fall by 5% minus 10%. The U.S. Treasury yield curve may steepen in a bearish manner, and the U.S. dollar index may strengthen. The real economy will bear greater downward pressure, with the 2026 GDP growth rate possibly dropping below 1% and the unemployment rate exceeding 5%. However, inflation may fall back to around 2.5% more quickly, achieving the policy goal of trading short-term pain for long-term stability. From a probability distribution perspective, the current market implies a probability of approximately 30% for Scenario 1, 50% for Scenario 2, and 20% for Scenario 3. However, it should be noted that the Fed's policy is clearly data-dependent. The upcoming non-farm payrolls, CPI, and GDP data may significantly change this probability distribution. Investors need to closely monitor key indicators, such as the month-on-month change in core PCE inflation, wage growth in the labor market, and the services PMI, as these data will serve as important basis for judging the policy direction. 7. The test of independence, the Fed's choices in the political economic cycle. The current policy divergence at the Fed occurs during a critical period of the U.S. presidential election and is inevitably affected by complex political factors, adding another important dimension to understanding the nature of the divergence. Historical experience shows that the Fed's policy independence faces special tests in election years, and the current divergence is to some extent a concrete manifestation of this test. Former President Trump's public comments on Fed policy have added complexity to policy formulation. He previously predicted that interest rates will be cut in September and threatened to interfere in the Fed's affairs if elected. This political pressure stands in sharp contrast to the Fed's efforts to safeguard its independence. Although Milan's radical rate-cutting proposition may align with the government's short-term demands for stimulating the economy, as officials appointed by the president, Fed governors still need to maintain independence from the political cycle. This institutional design itself has laid the groundwork for policy tensions. Chair Powell faces an especially arduous challenge of balancing acts. As the core decision-maker of the Fed, he needs to find a balance between internal divergences, political pressures, and market expectations. Historically, Arthur Burns' policies in the 1970s were considered overly influenced by politics, laying the groundwork for stagflation. This lesson has become an important warning for Fed officials. The way the current divergence is handled will directly affect Powell's policy legacy and shape the Fed's role in future political economic cycles. From an institutional design perspective, the Fed's decentralized structure should buffer political pressure. The different appointment mechanisms for governors and regional Fed presidents. Governors are appointed by the president and approved by the Senate, while presidents are selected by local boards of directors, have created multiple decision-making entities, which is conducive to policy balance and independence. The current pattern of 3 regional presidents collectively opposing the propositions of governors is to some extent a reflection of the effectiveness of this institutional design, promoting policy prudence through the collision of different perspectives. Market confidence in the Fed's independence is crucial. Cheng Shi, chief economist at ICBC International, pointed out, even in the face of rising fiscal dominance pressure and the risk of political intervention, the Fed still tends to advance the rate-cutting process in a prudent manner to safeguard policy independence and stabilize market expectations and institutional trust. Once this trust is damaged, it may lead to the unanchoring of inflation expectations and a significant decline in the effectiveness of monetary policy transmission. If the current policy divergence is not properly handled, it may be interpreted as a signal of weakened independence, a risk more worthy of vigilance than the divergence itself. Conclusion: a guide to navigating through policy uncertainty. The divergence among Fed officials on rate cuts essentially reflects the complexity and uncertainty of the U.S. economy against the multiple backdrops of slowing growth coexisting with sticky inflation, a cooling labor market intertwined with resilient wage growth, and the game between political pressure and independent decision-making. A single policy path cannot address all challenges. This divergence is not a sign of policy failure, but an inevitable process for central banks to explore optimal solutions in a complex environment. For investors, the current environment requires the establishment of a scenario-based investment framework, rather than betting on a single direction. Closely tracking core inflation indicators, especially services inflation, key labor market data, wage growth, and labor force participation rate, and changes in statements from Fed officials will help adjust expectations for the policy path in a timely manner. In a market with rising volatility, Diversified allocations and hedging strategies are more important than directional bets. For enterprises, it is necessary to prepare for coping with different interest rate environments. The uncertainty of borrowing costs requires more flexible financing strategies, and extending debt durations to lock in current interest rates may be a wise choice. At the same time, enterprises should pay close attention to changes in demand, as the lagged effects of monetary policy may significantly impact consumption and investment behavior in the coming quarters. For the global economy, the uncertainty of Fed policy means greater volatility and adjustments. Emerging markets should strengthen foreign exchange reserve management and promote regional currency cooperation to reduce dependence on the US dollar. At the same time, they should accelerate structural reforms to enhance the resilience of their own economies in response to external shocks. Policy coordination between developed and emerging markets has become more important to avoid competitive devaluations and trade frictions exacerbating global economic difficulties. History will eventually prove that the Fed's policy divergence may be an inevitable path to better decision-making. Under the realistic constraints of no perfect policy options, policies formed through full discussion and data verification, even if not perfect, are more likely to be in line with the actual needs of the economy. For the market, understanding the logic behind the divergence is more important than obsessing over the final outcome, as this is the key to grasping the future direction of the economy. In this 125 basis point policy storm, maintaining rational judgment and risk awareness will be an important guide to navigating through the policy uncertainty.